It does take us to our talk of the tape, the great rotation, and whether this week really marked a change in tone for this market. Let's ask Cameron Dawson, Chief Investment Officer for NewEdge Wealth. She's with me here at Post 9. It's nice to see you.
Good to see you.
This is quite a day.
Yeah.
What do you make of the market reaction this week?
There is enough of a short offsides position in those unloved areas of the market that just on positioning normalization alone, this rally can continue. Look at futures positioning in something like the Russell 2000. It's at its lowest levels since 2022, which just says a lot of people are offside. So if you continue to see this fading in yields, this fading in inflation and growth holding up, all of those things being very important for that to continue. But if those things do continue, this can continue to be a rip-roaring rally.
So UBS today says historically when the market experiences a significant one-day rotation from large to small caps, the trend tends to continue for the following 4 weeks. So we can expect this kind of activity, you think, for a month or so?
It happened at the end of 2023. We saw a 20% rally in small caps on a 100 basis point decline in the 10-year Treasury. Positioning was offsides then again as well. The question is, after you get that 4 weeks or a couple of months, what happens after that? Because the start of 2024 was terrible for small caps. You saw them give up all of that relative performance. But that's what we'll judge once we see positioning really start to reorient itself. And we think it comes down to earnings. Earnings have to play ball for the small caps and for value for this to last more than 4 weeks.
Okay, so let's get off of small caps, but go to value and other places that just haven't performed as well. Week-to-date winners. Real estate up 4.5%. Utilities up near 4%. Industrials up almost 3%. Materials the same amount. So these, what have been unloved areas of the market, I mean, utilities had that AI-related moment. You know what I mean? But is it time to really seriously look at those areas? Forget about the small caps for a moment.
Yeah, I think that they have a place in portfolios because there's places where there simply isn't as much stretched valuations. And what we see is that when markets do eventually correct, you have this dynamic where the bigger they are, the harder they fall, meaning that very stretched valuations become a risk and an unwind. We don't think we're going to have one of those soon, but picking up names that trade at reasonable valuations makes a lot of sense. But we would emphasize that you have to stay quality. It's not about dumpster diving. It's not about value traps, but quality names that have just been left behind this year.
Does that mean when you say quality names, are we talking large caps? Is this just like, no?
No, it doesn't have to be large caps. There are quality names throughout the size spectrum. We define it as things that have strong balance sheets, strong free cash flow, really good earnings stability. Right now, it is an everything rally. So junk is going to do better. Junk is your beta. It goes up a lot more. But in the event we do see that reversal, by sticking with quality, you protect yourself on the eventual downside.
Is this a rate cut rally? That's how we framed it the other day with the chair was on the hill and made what some have termed another pivot, a pivot even closer to rate cuts, and sort of left the belief to the market that they're definitely coming. The way that the data is shaping up, barring some major surprise, expect cuts and reasonably soon.
And it's cuts without a concomitant decrease in growth, meaning that you're getting the cuts without necessarily having growth fall off a cliff. And that, yes, there's fraying in the labor market, but it's not as if you're seeing mass job losses. There is still labor hoarding going on, which means consumers are still able to spend, even if some of them are just keeping their head above water. So if you get the cuts and you're not getting huge cuts to growth forecasts, that's why the market is up. Now, we are watching, though. Economic surprises are deeply negative, and you are seeing trims to GDP forecasts. So that is a wild card.
Well, I mean, you could make the, I think, credible argument that that's why the pivot, if you want to believe in that, happened in the first place this week.
Yeah.
Unemployment rate getting above 4% woke a lot of people inside the Fed up, okay? And the idea that where the primary focus was on fighting inflation, now they have to be equally minded, if not even more so at this point, on fighting the economy from slowing down too much and from unemployment picking up too much. And then you sort of wreck the story that you think you've written pretty well to this point.
Yeah, and if you can get ahead of a larger weakening in the labor force by maybe enlivening animal spirits, helping to support the the demand for interest rate sensitive goods. Look at the University of Michigan survey today. You saw a plummet in the is it a good time to buy a car or other durable purchases. Lower interest rates do help that. So if you were to be very optimistic, you'd say, hey, the Fed tweaks and we get a little bit of lift in that, and that the slowing in the economy is not enough to necessarily say that corporate profits are going to take a plunge.